Hi, and welcome to Institute for Supply Management's LinkedIn Live series on the release of the monthly ISM report on business. We started this last month and had a lot of fun with it, so we're back to break down the February numbers. My name is Dan Zeiger. I'm a senior writer and copy editor for Inside Supply Management. That's ISM's member publication. And we're here to talk about the February manufacturing PMI data. And at least the composite number did not meet expectations. It registered 47.8%. Now, that's caused some indigestion among investors and analysts this morning. And was that a setback for a U.S. manufacturing sector that is seen poised to finally crawl out of a lengthy period of contraction? Well, what makes this broadcast special is that it provides insights straight from the source, and I know that our source has a lot to say about it. So I'm pleased to have him join us. Let's welcome Tim Fiore. He is the chair of ISM's Manufacturing Services Business Committee, Manufacturing Survey Committee. And I know you've got a lot to break down on the numbers. The interviews that I've heard you do this morning, you've been very positive and very bullish that, the things haven't been sidetracked at all. So I, just wanted to give you an opportunity, what's the most important things that we should know in the data this month?
Okay, thanks, Dan. So the purpose of this call is to provide a lot more detail and information about what these headline numbers mean, because it's really a combination of the indexes that we get that you see and the comments that we get supporting those indexes. And there's a number of things that we can do to kind of validate where this thing is going to, if it's heading in the wrong direction, why, if it's headed in the right direction, why. And that's really my role and Anthony Evans' role to kind of figure that out so that you have a better understanding of what this all means. The summary on this is Dan is exactly right. We underperformed by almost 2 points. People were disappointed, but hold on. The fact is that our activity in February, with one extra work month too, and that one extra work month probably tied into the seasonal factor being as strong as it was, but one that we actually did better in the new order level, the production level, manufacturing inventories than we did in January. So the fact is we're moving in a positive direction, but in the month of February, we didn't move far enough to offset the headwinds that we had on the seasonal factors. When Dan and I were with you last month, I believe I indicated to the community here that the new order number was definitely supported by a tailwind on the seasonal factor, and that February was going to be a headwind. Well, in January, that tailwind was a 4-point plus up. In February, that headwind was a 4-point mark down. So we had 8-point shift between January and February that you need to have some really dramatic growth in the new order level. And it could happen because new orders are not really ratable. They can come and go at a buyer's pleasure. It's not like production where it's almost ratable. You don't just go from 80% output to 40% output month to month unless you have a pandemic or unless you have a major catastrophic event. On the new order level, you can see that because it could be stimulated just by people deciding to go ahead and re-up. Our new order levels are anything from long lead time items where it might be a 2-year lead time to buy it and receive it, or it might be a 2-day lead time to send the order and have it show up at your door. So we have a mix of stuff in here. So I tend to think it's somewhere in the middle here. We didn't have that huge step up in new order activity that the seasonal factor asked for, but okay, fine. Nonetheless, we actually had a positive month in February compared to January where we were over 50. I think it was a 50.2 or something new order level. Probably even better than that. And the same thing on the production side. So overall, I go through the 10 sub indexes every month and I determine whether they're positive, negative, or mixed. And in the month of February, I determined that all 10 sub indexes were positive, including new order numbers that look like they declined. And the reason I said they were positive is because on the raw basis, actual operational activity, they were better than January, coupled with the fact that our demand softening comments were cut almost in half in February compared to January. I tracked that out of the comments. We've had 30 some odd percent of our panelists in the general comment area saying demand is getting softer. In the month of February, only 17% said that. We had a 2-to-1 ratio of optimistic perspective for the future versus not so optimistic. That number is consistent for the last 3 months. It didn't come down. That's good. And then on the overall activity here, I track the percent of industries contracting at 49.9 or less, and I track the percent contracting at 45 or less. And we had a clear improvement in February compared to January. For instance, in the January timeframe, we had in the December timeframe, we had 85% of manufacturing GDP contracting at 49.9 or less, and we had 48% contracting at 45 or less. That 45 number is an arbitrary number that I picked. 43 is really, 45 is more caution. 43 is red. So I decided to pick 45 as a caution. So we were 85 and 45 back in December. We're now 40 and 1. And that's a clear improvement.
Yeah.
Which any way you want it, that's a clear improvement. So overall, I think we're on the right track. Like I've been saying all morning, this is not going to be a rapid recovery. This is going to be a slow recovery. And, what we're looking for is new order levels to come back at a respectable level, 54, 55. We're looking for backlog to get back up above 50, 52, 53. I expect to see the inventory level to get back above 50 for the first time in a couple of years. Probably in the next couple of months, I would expect to see that. We had a 2-point decrement on manufacturing inventory in the month of February. That's probably the strongest decrement we've seen on inventory. We've been seasonally adjusting inventory for a couple of years now. So, but without that seasonal adjustment factor, the manufacturing inventory number would have been 40, almost 48, which is the highest number we've seen in quite some time. So overall, I think we're on track.
Yeah, the number that's I had mentioned before we got on the air here, this was something that I wanted to ask you about. The number that really stood out to me, and I'm looking at my other screen here so I read it accurately, was the new order number. If you dive under the data, we have a table there, which our survey respondents tell us if, what percentage of them had a higher number of new orders and what percentage had a lower number. For February, nearly a quarter of our respondents reported that they had higher new order numbers. 58.2% was the same, and only 17.4% reported they had lower new order numbers. That's compared to 23.5% in January. And, that really doesn't translate to a new orders index numbers that would be in contraction territory. But as you have cited, the seasonal factor numbers were obviously an influence on that. If you want to elaborate on that, feel free. I know you already talked about it a lot, but also just, kind of explain why the seasonal factors, why we have them, and why it's important to, include those weights in the data as we compile them.
So first off is, a little bit of geeky stuff here. So Dan's exactly right. Those tables in the report, if you take 100% of the better and you take 50% of the same for the 4 elements that we seasonally adjust, new orders, production, employment, and inventory, if you do that, 1 for the better, 50% for the same, 0 for the worse, you'll see that the number doesn't align with the number on the right-hand side of the table. So if you want to track seasonal adjustment factors and non-seasonally adjusted numbers, all you got to do is that simple calculation. 100% of the betters, 50% of the sames, and you'll see it. The other thing is, and I've been saying this for a long time, couple of years, that there's really no seasonality around the pandemic recovery. We've been racing for 2+ years to catch up. And then we spent a year and a quarter trying to burn down all that racing, over ordering that happened. So those are not your typical season activities. The seasonal factors are primarily in there to account for changes in vacation periods, more likely changes in holiday periods. In the case of February this month, 29 calendar days in February, which equates to an extra work day. Generally February is a less work day. This time around, it's got an extra work day. So the seasonal factors try to adjust for that. And then it also tries to pick up issues that happened around weather patterns. And, sometimes you see that in the January, February timeframe with winter storms. I still remember the big hurricane that came through in August of 2017 that had a huge impact on the PMI number. That eventually gets factored into the seasonal factors. We have some experts that do this. Been doing it for a long time. They follow a very rigorous methodology that I'm a believer in. But I'm at the point here where it's almost like I would really like to take out that April 2020 through probably midsummer of 22 and ignore all that data when we look at seasonal factors, because it's definitely skewing the numbers. To go from a -4 in January to a +4 in February, that's a huge. How do you pick up 8 points like that? Through activity, that would have been almost an impossible bar to jump over. And I think we kind of felt that in January. Well, we didn't kind of get there. Would have been nice if we were 48, high 48s, but we weren't. So okay, fine. So my role is to help you understand what all this means in today's environment and what it might mean for the next quarter. And what I'm saying is, don't get overly concerned about a PMI number coming down. Don't get overly concerned about the new order number, the production number being in the contraction territory. We're still in the same trajectory. We're on a growth profile. It's not going to be a heavy, fast growth profile. It's going to be moderate to weak, but that's okay. I mean, that's all consistent with the touch and go, the soft landing. I mean, we never land because that means you go home when you finally hit the. So we're in a touch and go environment here. We're slowly growing out. It's more like a cargo plane, not a fighter jet, and we're on track. We'll see what March brings. I think we're going to see positive inventory numbers. We're probably going to see a slowing on the employment contraction, which will help the PMI. We'll probably see the new order level get back above 50 on its own merit. The production number will probably start to get to 51. I don't see the production number really going 55, 58, not outside of half two of this year. Remember, when we did our forecast, we said that half one would be lumpy, and here's a lump, and half two would be clearly better than half one. So I think we're still on that path, and I think the panelist respondents are supporting that.
Yeah. Well, let's take an opportunity to dive into some of the specific sub-index and numbers, and two that stood out to me as I was reading the report. And I guess it's always fun. I don't know how many times we get to make a Seinfeld joke when we talk about the PMI data, but that noted importer exporter Art Vandelay would have loved these new export orders and import numbers for February. New export orders was 51.6%, imports 53.0%. For both of those indexes, they were the highest number since July of 22. And I bring those up because I know we've talked in the past, including last month's call or last month's broadcast, about some of the slowing activity in China and Europe and how that is impacting American manufacturers. Were those two numbers kind of a surprise based on that? And do you think, I know 1 month is not a trend, but do you think it has potential to be a trend?
So I think the easier one is the import number.
Yeah.
The fact that imports grew in February compared to January is no surprise. We had a Lunar New Year that hit us in early February. We had a bunch of stuff that had to ship in late December, January to have inventory for February. And, so essentially we have early deliveries that happen in the month of February that normally wouldn't have been received until March. But because China shut down, it doesn't happen. It happens earlier. So not surprised about the import number being up. The export number is a bit of a surprise because last month there was no indication that Europe or China was waking up. And this month, we see a spike, 6-point change. Okay, but really it's a 1.6 point change from last month. So it's not dramatic. If you look at what's dramatic is we had a contracting environment at 45, and now we have an expanding environment at 52. The fact is that we're 50 versus 51.6. So it's not dramatic. I don't think it's really sustainable, although it's not a very large amount. If we ended up at 51 next month, wouldn't surprise me. I don't see that number going to 54, 56 in the near term because the German PMI is still hurt, and that's probably driven by China not being active. And they're tied together because a lot of German export market, and Germany is a huge exporter, goes to China. But China has to have the demand, and they don't have the demand. A lot of it has to do with the fact that the real estate market is really in a mess. And we all know that real estate doesn't clean itself up really quickly. And it's been a mess now for quite some time. So I don't know that China is going to help Germany very much. And I don't think that China is going to be back on that 6 to 7% growth profile. Everybody's talking about 3% or less. which is really weak. So the short answer here is it wouldn't surprise me if new exports remain at 51, 52, but that's not a big deal. It's not a big deal.
Yeah. As as I've been involved in reading and editing the monthly PMIs and especially the semi-annual report, one of the lessons that I've learned is that, you can, draw a lot of inferences and, on what executives and companies choose to invest in and how they're feeling about things. And you made one of those citations specifically when you talked about inventories in the report, where the sentiment seems like there's a increased willingness to invest in manufacturing inventory. And typically when supply chains catch up to growing demand, that's a recipe for manufacturing inventories increasing. Just talk about that dynamic. I thought that was really interesting.
Yeah, there's a couple of really good stuff that are in this report. Let me talk about three. I'm not sure if I mentioned the first one. The first one is chemicals and fabricated products are actually expanding. And those are two feeder industries to the other 16 industry sectors. Fabricated metal products joined chemicals this month. Chemicals has had a 5 to 6 month improvement. First, it slowed its rate of decline. And I think this is the first month it's actually in an expansion territory, almost 52, I think 51 and some change. So that's really good. So when that's happening, it means the 16, 17 other industries are demanding more product. Their new order level is up. I think the backlog actually grew too. So that's really good. We've been watching that for 2.5 years, 6 months of positive activity. Excellent. Fabricated metal products, again, they don't generally sell stuff direct to consumers. They sell it to other manufacturers who convert it, assemble it, and then ship it off to me and you. That's in an expansion territory too. Again, really good. So that's the first one. The second one is backlog at 46.3, up 1.6. I don't think we're going to see backlog actually enter the expansion category until sometime probably tail end of Q2. Remember, that's the result of output, i.e. production, and demand, i.e. new orders, and that when the new order rate exceeds the output rate or the output rate declines so much that the new order rate overwhelms it, then backlog grows. So, but I think we're in a mode here where the new order rate needs to exceed the production rate. I think the production rate is going to be stable or increasing over the next 9 months, which means then the new order rate has to be such that the backlog at the end of the month grows. And I think we made progress in the month of February. I didn't think the backlog would really grow until sometime in Q2. And I still feel that it's on its way. Backlog is a good thing because it allows CEOs and owners to have a lot more comfort in making investments in people and equipment when they have a pretty good order book. And, order books have been declining for 1.5 years, and they're ready for a pretty good order book. I think it's coming. So, okay. Wait. And then the last one here is manufacturing inventories. And we've been really low on manufacturing inventories for a long time. And in historical past, before the pandemic, manufacturing inventories essentially hang around 48 to 52. They're usually not a huge impact on the PMI. They're kind of a notional impact. Well, we've gone through 15 months of not investing in manufacturing inventory, trying to keep it out. The concern was liquidity, and the concern was getting stuck with inventory that they couldn't convert quickly into cash. Well, we're seeing a decline of almost a point in February, but the fact is that we took 2 points off through the seasonal adjustment factor. So that number would have actually grown, or actually not grown, but the rate of decline in inventory would have been reduced significantly, heading towards a growth profile in the next couple of months. So I think that's good. So our panelists are investing in inventory. They're not able to invest enough yet to expand their manufacturing inventory, but I think they're willing to do that. The fact that the supplier number is now really stiffening up, it's actually getting slower marginally, but getting slower, is going to be a headwind to expanding that manufacturing inventory number. So suppliers are going to have to meet the current need and also meet the needs of our panelists who want to expand their inventory that will allow them to be much more flexible with their customers. So I think it's, those three innuendos here, the fact that we've got feeder industries now expanding again, two of the biggest, strongest one, the fact that backlog, although it grew almost 2 points, it's on a path to actually, it slowed down its rate of decline, by almost 2 points. It's on a path to expand again, which is going to really provide a lot of assurances to owners. And we are investing in manufacturing inventory. You're just not really seeing it here in the month of February. You'll probably see it show up in March or April. And I'm hoping we're going to get back to a 52 on manufacturing. So, you need those kind of numbers. So here's a summary on it. New order number in the month of March can easily exceed 50. We'll see what the seasonal factor is, but March is a big month, especially for production. Maybe not so much from new orders. So maybe we won't have as much headwind on the new order level from a seasonal factor for March. In March, production should expand. We'll probably have a seasonal factor on that, but I would easily see us getting above 50 based on where we're at. New orders are coming in. A backlog is not declining as much. We're not going to run out of work. Employment will probably stabilize in the high 40s. I think we're still going to be destaffing all the way till May, and then that whole destaffing activity will convert to a hiring activity. I think the supplier delivery number is probably going to end up 52, 53 in the near future, and the manufacturing inventory is going to break 50 in the next couple of months. So those all combined says the PMI is going to get above 50. If not in March, it most likely will be in April.
One of the fun things about this broadcast for me is that, it's an opportunity to, for those who are kind of learning about the ROB data for the first time or becoming students of it. I get that opportunity to ask you how some of it works. And I remember last month we talked about the customer's inventories index a little bit and how that works. And I wanted to talk about a couple of things in tandem with each other that I keep an eye on, and I know supply managers should keep an eye on it as well. That's the supplier deliveries index in tandem with the buying policy tables, which are at the end of our report. The supplier deliveries index, for those of you who don't know, that's inversed. A reading above 50% indicates slower deliveries, which is typical as demand improves and the economy improves and demand increases. And then the buying policy tables at the end. You can get the specific lead time data in terms of days for capital expenditures, production materials, and maintenance and MRO supplies. Just talk about how those work in tandem with each other. Why they're useful for supply managers and buyers to know. And what makes them unique to the report.
Yeah. So let's talk about the buying policy first. So we do track it by CapEx, manufacturing materials, and MRO. And they're still sitting at high levels. We have not hit the troughs. And I don't think we're going to hit the trough because we didn't have a hard landing. When you have a hard landing, demand gets wiped out and output gets very questionable, and people start dropping lead times to attract new orders. And that has not happened. We're still about 25% above historical troughs on production material, which is a bit surprising. I get it on the CapEx because we've had long lead times on CapEx. We had CapEx that couldn't be satisfied. We have replacement CapEx that needs to be satisfied. The CapEx lead times will probably stay extended. The manufacturing lead times have not dropped to the extent I thought they would. But here's where the comments come in, because my panelist comments are clearly indicating that lead times are dropping, but that some of the commodity markets like steel and aluminum, they're not really seeing the benefit of that. And because those guys are managing capacity. So at the point in time where they should be dropping lead times, they're taking capacity out, which is maintaining lead time. So we'll see how all that kind of dances out over time. But the panelist comments are clearly supporting that overall my lead times are coming down, but they're not getting to the level that you normally would see in a reset, because we haven't had a reset because we didn't have a hard landing. Now, the supplier delivery number, the reason we have it in the PMI, and it goes in at a 20% factor, just like the other four sub-indexes, is exactly as Dan said. It's a measurement of the supplier's ability to deliver, how well they're delivering month to month. So it's kind of a surrogate for shortages. And when it gets above 50, it says that they're struggling more than the prior month. They're having more difficulty. When it gets below 50, it means that they're actually delivering faster than the prior month. And then you have a faster at a 45 or a 43 and so on. So we've been underneath the 50 number for a long time. And if you recall, during the grow out in the pandemic, we had a supplier delivery number in the 60s. So, the right amount of attention here is probably a 53. That's kind of where we're at equilibrium, because suppliers can never deliver fast enough because you're always moving the bar on them. That's just the way life is. When they when they deliver in 2 days, you want them to deliver in a day and a half. And then if they deliver in a day and a half, you want them to deliver in a day. That's just the way life is, especially when the buyer has a little bit more strength in the relationship. So, but we want to see this thing get back to a 52, 53, 55. Any of those numbers would be good. They can be dealt with. And usually what happens is the slower the deliveries are, think 57, 58, the higher the manufacturing inventory account at the panelist companies gets. Because to accommodate the fact that they're not delivering as reliably, our panelist companies need to have more manufacturing inventory on hand of their suppliers so that they can still build to their plan, even though the suppliers are coming up short. So that's kind of it in the summary here. They're all kind of tied together. That's why I look at them all in the input side. And so the lead times are not going to come down any further because we didn't have a hard landing. That's one of the bad things about not having a hard landing. We never got to a super low inventory, but okay, we can work with that. The manufacturing inventory account didn't grow as much as I would have liked to have seen it, but that's because we had a seasonal factor in there that took off almost 2 points. I don't think we're going to see that in March. And, I should probably check that before I make the statement, but I can see us getting back to a 51, 52 within the next 3 or 4 months because panelist companies are willing to invest in manufacturing inventory, whereas in the prior 2 years, nobody wanted any inventory. It was all about liquidity. And, suppliers are moving towards struggling more, and they're going to struggle more until demand gets to the level where they go out and hire more. I mean, some of our panelists are also suppliers. Many of them are. There's a need for new CapEx, probably to replace worn out CapEx that they couldn't get a couple of years ago. That's going to start to flow in. That's going to help them. The whole productivity plan, production capacity expansion of about 5 or 6% in 2024 is still on track. We'll do a checkup in May on our forecast to see whether the plans are still to do that. I don't see any reason why they wouldn't be.
Yeah.
So things are kind of in play here. Revenue is stable. New orders are starting to improve. New export orders came up in the month, but I'm not sure that's going to be there for long. Backlog starting to stiffen up. We're still releasing people. It's probably a cleanup activity going on from, hire anybody who can walk to, okay, who we really want to keep now. We're investing in inventory. We're investing in CapEx. Suppliers are struggling a little bit. Customers still don't have enough of our product. That's going to kind of bounce around a little bit. I don't see us going to too high on the customer inventory level in the next couple of years. So we're going to either be on the low side of just right or probably on the high side of too low.
Yeah. Well, hey, yeah, that's a great summary, Tim. I mean, I know, it's easy to be cynical and, think that, okay, you're just looking for a happy face to put on, but this month's data really emphasizes the importance of looking under the hood and, seeing, what goes into the numbers and not just looking at the composite PMI and just saying scoreboard. So, it's very important to do a deep dive like this, and I'm glad that we were able to do it. So thanks a lot. Hey, if you'd like to be a part of, our manufacturing and businesses survey committees, play a very important role in shaping data that is a key indicator for the U.S. economy and not only the manufacturing and services sectors, you have an opportunity to do that. It's a great way for supply management professionals to give back as those responses, as we've elucidated, those inform the PMI reports. Confidentiality is always maintained, and it only takes 10 minutes or less to respond each month. So for more information and to sign up, visit the URL right there on your screen, ismworld.org. Join the panel. So yeah, it's a great way to give back. So yeah, thanks a lot for joining us. That wraps up our call this month, or our broadcast recapping the manufacturing PMI data for February. Really interesting stuff. And join us on Tuesday when I'll sit down with Anthony Nieves. He's the chair of the ISM ISM Services Business Survey Committee, and we will break down the services PMI data. So for Tim Fiore and a couple of people behind the scenes who helped us today, Angela Miller and Christina Kale, thanks for joining us, and we'll see you Tuesday, and we'll see you next month for the manufacturing breakdown again.
Thanks, everybody. Appreciate it.